Okay, we'll go ahead and start. I know people are still gathering in the room, but we have a few housekeeping things to get through first. So I will begin. We are going to be discussing challenges and opportunities for software and technology investments today. For those of you I have not yet had the opportunity to meet, my name is Lena Dobrier. I'm the Director of Operations at Opus Connect. We are a lower middle and middle market M&A focused organization catering to transactional professionals, private equity firms, investment bankers, lenders, etc. We are doing a ton of events, I think 250 events this year. It's insane. Many different formats. I know many of you are participating in our tech software focused Deal Connect following this event, but we're doing Opus Mind, webinars like this, of course. If you're interested in learning a bit more about us, who we are, how we can help, please reach out to my colleague, Swayze Yancey. His information is below. He'd be happy to answer any questions that you have. Today we'll be taking Q&A. So as questions come to mind, please feel free to submit them in that Q&A bubble below. We'll ask that you please avoid the chat function and just make sure to submit your questions in that Q&A bubble. Our moderator will be monitoring that, and we'll try to get to as many as possible. These events, of course, would not be possible without the support of our sponsors. So we definitely want to give them each an opportunity to say a few words and introduce themselves. I'm going to start with you, David Kogan. Please go ahead and introduce yourself and your firm, sir.
Good morning, Lena. Hi, this is David Kogan. I'm the Managing Director of Sapient Investigations. We're an international corporate intelligence firm, and really for the private equity world, we take care of all your due diligence needs. We work on a lot of M&A deals, looking at management teams. We do a lot of joint venture partner type work. We work internationally on that. We've been working with lenders quite a bit here, kind of the tail end of COVID. We also have a very robust litigation practice. So any kind of business dispute work, we've been quite active in, asset searches and the like. It's always great to be at Opus Connect. We've been doing this for 10 years, and it's really a wonderful opportunity to meet people in this space. Anyway, thanks, Lena. We'll look forward to meeting everybody later today.
Always great to have you, David. Thank you so much. We're going to shift here to Alliance. And Fran, I'm going to go ahead and unmute you. Please introduce yourself and your firm.
Good morning. Thank you, Lena. Alliance is among the fastest growing insurance brokerages in the industry. As the 9th largest broker in the US, we place approximately or over 18 billion in written premiums, insurance premiums. While our influence spans a broad array of sectors, industries, and geographies, I'm a senior vice president in the M&A practice. Within this vertical, we provide insurance diligence and brokerage services across employee benefits, property and casualty programs, directors and officers insurance, rep and warranty insurance, as well as retirement plans. So look forward to speaking with everyone over the course of the day. Thank you.
Thank you, Fran. Nick Benedict, I'm going to go ahead and unmute you, sir. Please introduce yourself and your firm. Nick, are you there?
Yes, I'm sorry, I was muted there.
Awesome.
Thank you. My name is Nick Benedict. I'm Managing Director of King Edward First, which is a digital marketing and strategy advisory firm for PE-backed firms and similar companies in similar situations. So we provide a range of services ranging from paid media campaigns like on your social media or Google ads, through to search engine optimization, to email marketing and overall marketing strategy, and look forward to being part of today.
Thank you, Nick. And then, of course, White and Williams, we're going to wait until we introduce Ryan Udell, who's our moderator today, but I want to give him a quick shout out, and he'll give you more information later. Before we begin today's discussion, we'll shift to the next slide. We do have 2 poll questions that we'd like to ask. So I'm going to go ahead and launch the first one. And this is going to give us a good idea of who you are. So please, we'll encourage your participation. Let us know, independent sponsor, investment banker, capital provider on the debt or the equity side, service provider, or other. We'll give it 20 seconds and then we'll move on. Okay. So it looks like 10% independent sponsor, 38% investment bankers, 5% capital provider on the debt side, 19% on the equity side, 19% service providers, and 10% other. Thank you for participating in that. I have one more question, and it's around in-person events. We would like to know, when are you comfortable attending them? So go ahead and launch. Now, not until you get the vaccine, never. You're good right where you are in the virtual world. Let us know. We'll give it 15 seconds and then we will move to the discussion. Okay. Interesting to see how these breakdowns have shifted over the last few months. 42% now, 54% not until you get the vaccine, and 4% very comfortable in the comfort of your home working virtually. Thank you so much for participating. And without further ado, we'll shift to the next slide. I'd like to introduce today's moderator, Ryan Udell of White & Williams. Ryan, the floor is yours.
Thank you, Lena. Appreciate it. And if folks are having a difficult time hearing me, I'm hearing a buzzing in my AirPods, and so let me know and I'll switch to my speaker on my computer. That's one of the hazards, I guess, of doing these things remotely. So my name is Ryan Udell, and I'm currently a partner at White & Williams, which is a regional firm headquartered in Philadelphia. White & Williams has been a sponsor and participant with Opus Connect for several years now. We really love what Opus Connect has done both in person and now as they've pivoted, like a lot of providers to these types of events, to online, and they've done a fantastic job. Obviously, 250 programs a year is fantastic amount of programming. And before I move on to sort of our topic and enough about me, I just wanted to mention that that I actually, and this is a little bit odd, but I'm actually leaving my current firm and I'm transitioning to a new firm called Ballard Spahr, which is also a Philadelphia-based firm, but it has got a little bit broader of a national reach. And those that are interested, I can talk to you more about that later offline. With that being said, let's move into our panel discussion, which is somewhat of a wide-ranging one, but it's really about, at a high level, what we've done. And oh, I should actually introduce our panelists first, so I apologize for that. So let me introduce our panelists first, then we'll get into the discussion. So Andrew Olson is our first panelist. Andrew, why don't you give you a couple minutes or seconds about yourself and your firm, please?
Sure. Well, hey, good morning. Appreciate the opportunity to join you. My name is Andrew Olson. I'm a partner with Boathouse Capital. We're located in the suburbs of Philadelphia. Just a little bit about what we do. We focus on making investments, structured capital and growth capital investments into entrepreneur-led companies in the technology, tech-enabled services, and healthcare arena. I focus in particular within those three within the healthcare vertical, which spans both technology and services. We're investing out of our third fund, where we're writing checks up to $40 million per opportunity, looking for businesses that have been entrepreneur-led and looking for a partner. We're traditionally the first institutional investor in our companies and helping try and bridge companies from an internal or family-run dynamic into and working through growth stages and then potentially into larger equity funds over time. So it's not uncommon for us to be working with early stage venture firms as they progress, venture-backed firms as they progress into PE, We go coast to coast. So it's a little bit about us, and I'll turn it over back to Ryan for the others. You're muted,
Our
Ryan.
next panelist is Marcus Margarian from Chatsworth Securities. Marcus, why don't you tell us a little bit about yourself and your firm?
Marcus Margarian from Chatsworth Securities. We specialize a lot in the digital space. I've been in the banking space for over 20 years, starting with derivatives. Then we went to the emerging market banking and took a break from banking to become a UX analytics SaaS vendor and customer success person. So coming back at Chatsworth Securities, we've been using those skills and recruiting people who have tremendous amounts of operational experience at tech companies in order to better serve our customers. Recently, we've been quite successful with the payment space and in the analytics space. So I hope to share that knowledge with the audience.
Great. Thanks, Marcus, and appreciate you. Marcus is from the West Coast, so appreciate him getting up early for the panel. Our next panelist is Tom Lay from Seacoast Capital Partners. Welcome, Tom. Tell us a little bit about yourself and your firm.
So Seacoast Capital Partners, the main thing to know about us is that we're a private equity firm. We're on our fourth fund, but we don't do change of control deals. And we've all sort of heard the term jambog, just another middle market buyout group. Seacoast Capital Partners is not a jambog. We don't do change of control deals. So if you have a company where the earnings have been an asymptote and the sellers want to sell and head off to the beach, that's great. But not for Seacoast Capital Partners, sell it to a jambog. On the other hand, if you have a company where the growth rate is up and to the right, they want capital for growth opportunities, which is most of what your growth strategies, or to acquire another company, or to get rid of a shareholder you don't want hanging around. Some combination of those three things, that's where we come in. We stroke checks between $5 and $30 million into companies that have EBITDAs between $2 and $15 million. And given that we're non-control investors for a company on a growth strategy, we're likely to be a far higher NPV outcome for those companies rather than doing change of control. But we are kind of a gateway drug for institutional capital.
It's a good way to put it, Tom. Appreciate it, and looking forward to the conversation. And last but not least, we have another Tom Kastner from GP Ventures. Tom, welcome, and give us a couple seconds about yourself and your firm, please.
Yes, hello. GP Ventures is an investment bank based in Chicago. We've got 5 people total, 4 here and 1 in Japan. Our focus is on tech and electronics deals, and both sell side and buy side. And our projects are generally in the 1 to 10 million EBITDA range.
Great, thank you and welcome. Okay, so today we're going to talk a little bit about software and technology, some of the opportunities, obstacles, and the like coming out of COVID and roaring into the quote unquote new roaring 20s. And as I was looking to prepare for the panel discussion, it's interesting because if you think about it, a lot of tech businesses did fairly well in COVID because we all utilized technology to essentially address the immediate need of handling COVID and keeping commerce moving. And likely, we think, and I'm interested to hear from the panelists, that a lot of that will continue and accelerate going forward. Interestingly, though, just a couple basic statistics, and we'll move into the discussion. Investing in tech in the fourth quarter was the largest sector by far out of all sectors, and probably makes sense. Secondly, and additionally, interestingly enough, tech investing now is about 1/3 to 40%, depending on who you ask, of PE investing, and that's up from just a little over 10% over 10 years ago, around 10 years ago. So as you can see, the technology sector in general, and obviously those businesses that have recurring revenue have become very important to PE investing, whether on the growth stage or on the buyout stage. And so with that, let's get into some of the conversation. So obviously we've just come out of COVID, and it's impacted all of us and how we run our business, how we've done deals. Let me turn this over to, let's see, I'll ask one of the bankers to start with. Let's start with Marcus. Marcus, what have you seen as we've come out of COVID in 2020, and sort of what are you seeing coming into 2021 as areas of opportunity for technology investing?
I mean, at this point, I'd say going back to basics. People are dying to go back to the store, and there's tremendous amounts of things like retail technologies and things that will get people back into the store, but in a more modern way. This is an amazing opportunity for digital transformation to occur in areas that normally would probably not have seen it for another 10 years or so. Even right now, where one of my groups out of the UK that I'm working with, it's we're going to rent out a store to make it into a post-COVID store with virtual fitting rooms and things that focus on social media and all these elements that the world has become accustomed to today.
So in essence, what you're saying is that obviously we can't all live virtually forever. Obviously we're social animals, but what we're seeing is that the acceleration of the use of technology as part of that social interaction. And I agree with that. I mean, that started, I remember being in California at the JP Morgan healthcare conference a couple of years ago, and going into an Amazon store where there's no, you check out, you walk out, it picks up your, on a near field communication, your Apple Pay, and you're off to the races. And I think that makes a lot of sense. How about our other banker on the panel, Tom Kastner? What do you see?
Well, sure. And I guess what we're seeing now, and we think that that'll continue for quite some time, is remote anything is extremely popular, whether it's remote patient monitoring or anything to do with connectivity and not having to go into the store. Although I certainly agree that we'll be heading back to stores, and then of course anything to do with recurring revenue. That's kind of the holy grail, and I think that's the primary reason why so many private equity investors have moved into the space, is that there's so much more recurring revenue. But say, we work, we do a lot of projects in electronics, but even our electronics deals have seen a nice increase in revenue in remote projects, whether that's say remote physical therapy products, or again, remote medical products. So I think that trend will continue for quite some time.
And let's just continue with that theme for a second here, and let some of our investors on the panel weigh in. Let me go first to Andrew. Andrew, maybe sort of piggyback a little bit on that and what you're focusing on and your firm is focusing on, and why.
Yeah, certainly. I think every conversation we now have with a company is going to include some kind of technology element. It's going to address how do your business model conform to remote. Certainly within the realm of where I spend my time, the healthcare vertical, a lot of telemedicine, had a lot of friction around it, or whether it was unfamiliarity with use or payment models, reimbursement that really didn't make it possible. All those things have been stripped away with COVID, and I think that is probably a permanent change. Certainly, some regulations you now realize after the fact weren't necessary, and I think that we've discovered that people who now have been forced to try remote care, are comfortable with it, and that some of the regulations that stood in the way of it may not have necessarily been good. So that's certainly something that I think we've seen change. We've also seen change around, understanding payment models. Technology is not all the same. So when we think about recurring revenue, what does that mean? If it's truly transaction-based revenue, we've had to understand, well, how does that impact? We've got technology businesses that are healthcare, but they rely on visits to patients. And so when patients are not able to come in or to an office, those revenue streams are different, even though that they get categorized as technology. And then the last one, it's sales and marketing. A lot of our companies were, as many companies, were doing person-to-person, live events for leads, and not even forced to try and deal with remote lead generation and working new business and closing new business remotely. So those are all things that cut across the investments that we're looking at, regardless of the specific industry.
Great. Thanks a lot, Andrew. And I guess, and Tom Lay, maybe I'll move to another question unless you had something to add there. But the question that, sort of comes to mind now is, there's a lot of consumer facing technology, but maybe talk a little bit about interest in B2B technology and investing there.
Well, I will tell you that our investing, again, as I mentioned earlier, is all non-control investing. So, we are trying to help grow these companies. To the extent of direct B2B, we have not done any B2B. Right now, I'm working on a D2C company right now. And what is fascinating to me about that business is the growth rate. And I can't announce this deal because it's not closed yet. But in 3 years, it went from zero to in excess of a $10 million EBITDA, so far with no outside capital. Now to take it to the next level, they need outside capital. That's the reason why we've gotten involved in this thing. But I guess the ability to ramp these companies, again, the product that they're selling, this is a company based in the US, but all the manufacturing is done offshore. So in many respects, it's a virtual company, although they're up now to nearly 100 employees. But when you cut to the core competence of this business, what it really is at its core is a data analytics company. And it's evidenced in the people they hire. The people they hire have backgrounds in physics and a lot of the hard sciences that are going after, and obviously computer sciences backgrounds. But one of the things that intrigues me about this business is they currently have they're a one product company, but there are many, many other products we can run through this data analytics, because right now, as you know, today in that world, all the advertising of any merit is going through sort of Google, Facebook, TikTok, and the companies that can exploit that adroitly are the ones that will be successful.
Yeah, that makes sense. Does anybody else want to weigh in on, I think the data analytics is really a key driver and will continue to be. I mean, there are buzzwords, but that truly, if you can understand and exploit the data, you're going to have a competitive advantage. Does anybody else want to weigh in there or have a comment on the use of data analytics?
Yeah, data analytics is probably the most honest piece of information you'll ever get in your life, especially when it comes to first-party data. If you go into a focus room and ask people, do you like Coke or Pepsi? The first person who speaks will influence everybody's response. With analytics, the data you capture is so independent individual that it's the most precious kind of data because there's no other influence. So when you're working with data analytics companies, the most important thing you have to do is understand what their database is. So anytime you look at that, ask for their schema, ask for how they're capturing the data. Don't even look at a presentation, because once you know what data they're capturing, how much of it there is, that statistical data becomes so relevant to what you're investing in. So, and having worked in this space for 2-3 years, it's amazing.
Yeah, and not to make a joke here, but you could probably utilize that, or people could utilize that better in the last several elections. Because surveying is kind of broken. That's the way they do it now.
Yeah, been lying.
So anybody else want to weigh in there on data analytics, or maybe even, another buzzword, which is AI, and it's kind of a little bit less better understood than data analytics. You can understand sort of where things are coming from, but AI, anybody have a comment on AI and how they foresee that being utilized, both just in general, but also investing in AI companies?
The way that it's used today, it's not AI. It's machine learning.
Right.
And basically, because the way that you're capturing data goes into a database, which they use with SQL. And then within that database, the computer reads historical data. So it's kind of like pre-COVID and post-COVID. In February of 2020, your data said one thing. By April 2020, You can forget about everything that happened before February 2020. And until you get rid of the SQL model, which is just a fancy way of saying Excel, you won't have real AI, because the computer is dependent on historical data. So it's never going to react to something unless it has enough information to react to it. So that's why it's really just machine learning.
Got it. And Marcus, that's why we have you here, because everybody else, including myself, understands about half of what you just said. Let me move to sort of some themes from 2020, coming out of 2020, and then we can move into our next basic topic here. So for the two investors on the panel, Andrew and Tom Lay, what did you learn about doing deals in 2020, like through the pandemic? Give us some thoughts on what you learned and how you may use that to change best practices going forward.
Well, certainly, I think like our company, as I mentioned, trying to source deals, trying to, close deals in a world where, travel is more limited, was very new. I think that we relied on a lot of, you sell it yourself as much as you sell the firm, our capital and what we can do. And you try and do that best, in a room with someone. And so, having to morph into, Zoom to get deals done and sell and market was a pivot. And, how you source deals outside of kind of normal means, like that's something that we've had to learn how to do. And, I think it's come with a lot of benefits. We still, I think ultimately, before we close, we like to make sure that we're still, pressing the flesh and meeting the people that we're doing business with, because, in the scale of companies we deal with, it's still very much, a handful of key people that make the businesses go. And so, I think we've created a lot of efficiency in being able to avoid a lot of, travel and plane trips that, we can just very quickly do back-to-backs. We can get through management meetings more efficiently. Friction is a lot lower, so it's easy to kind of have follow-ups. I think all of that's been good. And I think for the existing companies that we've had, I think there's also been a good learning around dealing with, crisis and change. And I think for a lot of our executives, there's a learning that comes from that, or how do you deal with uncertainty? A lot of our entrepreneurs, a lot of tech entrepreneurs are relatively young. They may not have seen the last crisis 10 years ago, if they're in their 30s, or they certainly weren't CEOs or at the scale of company that they are today. So I think that for a lot of our executives, the speed of change was a great learning experience, and for us, I think that's part of the value of being investors, having seen that and kind of sharing some of those best practices that became much more valuable. So we've done remote sessions like this among our CEOs during the pandemic, to just say, how are you dealing with a certain issue? And those things were very valuable.
From my standpoint.
How about you, Tom?
Yeah, from my standpoint, when this whole COVID thing first came down, roughly when really the world kind of locked down in the middle of March of last year, I don't know about you guys, I thought it might be 2 weeks, maybe 2 months, something like that. And here it is, 13 months later, we're still working out of our homes, or in my case, a daughter's bedroom is long since gone. But we've adapted because we had to, and we've got a fund, we've got to put that money to work. We have institutional investors, and they expect that money to go out. What I will say is that, we have gotten deals done through this process. We've been a learning process along the way, but I think forever things have been changed because all of us have become very adept at using Zoom and other Zoom-like platforms. I think that obviously the business travel has been curtailed dramatically, although even during the Zoom, I made trips that I had to places like Texas and Utah and Chicago. But I do think that there's going to be more of a hybrid going forward, that the absolute need to have as many face-to-face meetings, people have become, for better or for worse, more comfortable with using Zoom as a de facto face-to-face meeting. What it doesn't do, of course, is actually, seeing facilities or, actually, kicking a tire, so to speak. That won't change. And I think, now that some significant number of us by June 1, some significant number of the United States will have both of the vaccinations, you're really going to see things opening up. I can look at our portfolio. every one of our portfolio companies, we currently have 18, was affected in some one way or another. Oddly, some were affected very positively. We have companies in the last mile distribution that are up significantly because of the fact that there are more goods delivered to businesses and homes. And so that part of the business grew dramatically. But then we had another sort of a high-end seafood restaurant in the Boston area with 40 locations. It got clobbered, of course. All the everything in lodging and hospitality got whacked. So, these are all sort of the challenges. And this was, I think that in many respects, the COVID-19 was sort of the black swan that you read about in textbooks, and all of a sudden it happened.
Agreed. And so did you guys, I know, Andrew, you said you still like to press the flesh. Did you close a deal during COVID, either of you guys, where you didn't actually meet the people in person?
Never met them, but the process was closed during COVID, but there actually, in all cases, were face-to-face meetings.
Okay. Yeah, I mean, and some folks have different viewpoints on that, and some were able to, or at least with add-ons, it was a little bit easier than it was with a new platform deal.
I gotta tell you, first of all, I think we have institutional limited partners, and to the extent if we did a deal without a face-to-face meeting and later that deal blew up, I would not want to have that meeting with my limited partners. Well, Tom, of course you met these guys face-to-face. Well, no, I didn't. I just did a Zoom with them. Like, okay,
right.
You have proven yourself to be an idiot, So, no. The answer is no. We've done, obviously a lot more Zoom meeting, but in every instant there were face-to-face meetings. Moreover, some of the diligence has to be done in person.
Yeah, and look, you're right. I mean, I think from what I see for my clients too is that they espouse the same sentiments, and I think again certain things we can't tell. I'm talking to you over Zoom, or I'm talking to you guys over Zoom. You can't on Zoom. There's still not a technology that can sort of tell you how I'm really reacting, and like you can sort of see it, but you can't really see it until you see them in person. We're not good at judging that well yet over Zoom how someone's going to act, and ultimately that's why you have to meet them face to face. There's been a lot of studies around it. Now Marcus wants to jump in here, so Marcus, let me let you jump in.
When I left banking to go work at this UX analytics company, I'll be straight. It was very difficult to do Zoom. I mean, we had Zoom, Join Me, Chime, you name it. We tried everything. And many of these tech companies run by these 20 and 30-year-olds, they close deals at like 50,000 a month. They never meet the people. We closed, a payments deal between Switzerland and the Bahamas because that's where the other company was incorporated during COVID, and the two owners never met. And what you have to do is really understand what is the most plain vanilla way to get communications across. And it's really a lot of show and tell. So if you want to, if you want to swap your equity with the Department of State or whatever's equivalent in the country of Switzerland, you really have to show through digital means a way for that not to have. We had recurring mails going back and forth 3 times because the lawyer was unable to utilize technology for us to facilitate things. So it really comes down to, if the 20 and 30-year-olds could do it, it's because they as a collective group have been digitally transformed, and they are able to use all the tools necessary to close deals virtually.
Yeah, and look, it remains to be seen, candidly, whether or not going forward, longer term, it's generational, and I guess time will tell to do either big growth equity checks or buyout deals entirely remotely.
I don't recommend you do virtual deals if you're doing something like industrial factories, for example.
Well, yeah,
if it's analytics or payments or something, yes.
How about Tom Kastner? Anything to add here?
Well, sure. I think without Zoom meetings, we probably would have had a hard time closing deals in the second half of last year. I would say the first half, but at least the second quarter it was pretty tough to close anything. But we certainly feel that it's one thing to start relationships and to gather information via Zoom. It makes it so much easier. But I'd feel really nervous closing a deal without any face-to-face meetings whatsoever. Now, much less so if it's software based or IT services or something like that. But if it's more manufacturing, you really got to pound the flesh and get to know people in person. No, I will say, kind of on the flip side, we've signed up a couple clients recently that we have not met. Only met via Zoom. We've not seen their facilities yet. We've seen them via video, or other methods. And so that makes me a touch nervous, I must say. But one thing, because everybody's using Zoom, Zoom is an excellent way to see how people react on Zoom, for what it's worth. And you might meet them in person; they could be completely different. But as more of us are doing business on Zoom, I think it's important to see how people conduct themselves on Zoom.
So you're saying that obviously you shouldn't dress up as a cat or something of that effect when you're on Zoom. So let's just talk about technology and doing deals for a second, because everybody's mentioned Zoom, and Zoom is kind of almost like Xerox. There's obviously other platforms to use for remote video conferencing, but me personally, I like Zoom the best. Obviously, everybody has their favorite one. Some work better than others. But aside from video conferencing platforms, is there any other technology or automation? Virtual data rooms have been in place for a long time, so I'm not sure we should talk about those. But anything else that you started utilizing in COVID that you will continue to use to help you get deals done that you really didn't consider before COVID? I'll just open it up to the panel.
Yes. For data rooms, for example, they have tremendous amounts of analytical data. So we were doing a deal with an oil and gas refinery, and because certain investors were not looking at specific pages that I needed to look at, I knew before the call that I could reference things that they didn't know. And I knew before the call because the analytics told me the story of the customer's journey or the investor's journey. If it's an e-commerce company, we'll use things like Ghostery or SimilarWeb because we want to see how their traffic is coming and going. We want to know what kind of apps they're actually using for their websites. If they're using things like Shopify, if they're using things like Hotjar versus like, Quantometrics for their UX analytics, if they're using Bing ads or Yahoo ads or Facebook ads, et cetera, because then you'll know where you're getting your customers from. It's kind of like foot traffic on a retail store. You want to know what kind of traffic that's being driven. Now, if you're doing with a company that's like a digital bank, you really need an on-site analytic tool to see exactly how those companies are using things like filling out the form and how many pages that these people are actually looking at. Because depending on what you're selling or what your price point is, it makes a massive impact on what your call to actions are on your websites. So these digital tools, I'll give you so much insight that your customer or prospect will never tell you. Yep. And many times these CEOs don't actually know what they're doing or what they actually have plugged into their things. I mean, I think, sorry.
No, just to follow up, just to say that, and this e-commerce company that we have, right, or that we're working on now, immediately if you put an ad, the number of clicks, and the ratio of clicks to closes, and when these people come back, how long they've been on the site, the actual different windows they've clicked through, where they're located. There is so much information. It's a little bit creepy, really, but there's so much information out there on people, and so right away whether an ad is effective or ineffective. And if an ad proves to be ineffective, you can very quickly punt on that ad. Creating these ads in the digital world is actually very, very inexpensive relative to the kind of ads you traditionally saw, like we grew up with Super Bowl ads with Budweiser, with Clydesdale horses and all that kind of stuff. Those are very expensive ads. They're like making a little movie. Whereas these digital ads, they're very simple to make on a relative basis. And the models and actresses you hire are relatively inexpensive to hire. So you can try a lot of different things. But if in fact that ad does not get traction, you can dump it quite quickly. But ads, like anything, as we all know, ads wear out over time. People get tired of seeing the same ad over and over and over again. So you have to refresh these ads, but you kind of play off themes that have worked well in the past. So, but the ability to know versus the old days when advertising was on newspapers or in television, there was absolutely no, just on a global maybe, but on a specific level, who the hell was buying that product? You had to kind of guess at it. You don't have to guess anymore.
Yeah, I mean, I agree.
Yeah.
Also, one of the things that we've also seen that is pretty interesting with the remote, it's there's big data. I mean, we've seen security issues become more prevalent across our companies, which is a byproduct, I think, of people being remote. We've seen a number of effort and attempts, at kind of wire fraud have gone way up in our companies. There's obviously network type of security that everybody thinks about, more remote demand on kind of capabilities and bandwidth, but it's also just kind of saying it like people disguising themselves and trying to like hack in systems, and then we've had, I think, several instances where people have disguised as key employees and send emails saying to send wires and things like that. And so basic things that have kind of been exposed here about workflows within our companies, and that you kind of have to think through now, because you used to go over to the controller and ask him if you needed a wire. Now it's doing all remote, and those things can get disrupted. So that's been one of the interesting things we've seen come out of this process, that it's been a learning for a lot of companies remotely, is you're going to have to operate differently, and that may include simplistic things like sending out payments.
Yeah, makes sense. And obviously that, Zach maybe sort of segues into, a couple of things that I'd like your guys' thoughts on. We touched upon a couple of areas that I think, you're saying, and I believe are sustainable beyond the initial sort of COVID bump, if you will. Like, so some of them are the ad tech space that we've talked about a little bit here. You've talked about cybersecurity. I think maybe you guys could give us your crystal ball on what areas of investing you think will be hot, and just talk a little bit about that, and then we'll move into some what I think everybody wants to hear about is sort of what are current deal terms and what would we expect them to be in 2021. So just a couple of thoughts maybe from one of the panelists. I'll open it up to the floor for sort of what they think they're looking or excited about.
One deal I really like that we're working on is we're talking about all this data. Now, what can you do with it besides cover a cost with the server? One of our clients actually takes the data, let's take healthcare, and they put it into a trust or a data trust. And then you could borrow money against it. So United Airlines, American Airlines just did $5 billion loans against their loyalty programs. You could go to a company like Flatiron and have something like oncology records that are going to be shared with Johnson & Johnson, and Johnson & Johnson is able to access that information securely. Anonymizing the data is very simple. It's a couple keystrokes on SQL and you anonymize it, but providing real-time data all the time that keeps refreshing. So taking an asset that was not on your balance sheet and now adding extra value, which is a huge thing when you're working with tech companies, because many times when we talk with tech companies, a lot of owners don't actually fully grasp their full asset value.
Makes sense. Anybody else want to comment?
Well, I think the trends that we go, it doesn't mean that, look, there's a lot of ways to invest. And again, we're doing something a little bit different in minority rather than change of control. But the sectors we like a lot, we like healthcare a lot. We have a lot of healthcare investments. Broadly speaking, we like logistics a lot. But you go, I'm an old dude, and I look back, kind of the investing I did in the past, and a lot of the kind of investing I did was in sort of blood and guts manufacturing companies. A lot of those blood and guts manufacturing companies aren't really around anymore in their current state. So the thing I like about healthcare, that if you're delivering healthcare services, you can't outsource that to India if you're actually touching the patient, right? In logistics, same sort of thing. If you're actually delivering something, you've got to be there on site. You have to have rolling stock to deliver this stuff. Now, the way that is done is changing, and I think that we will. I think it's very likely that I don't own an electric car, but I imagine in 5 or 6 years you won't be able to buy, at least in California, you won't be able to buy a new internal combustion car. Moreover, as we're getting closer and closer to autonomous driving, we may not even want to own cars. It'll be some sort of, some say, hey, I want to, go to Lake Tahoe, and I have 5 people, maybe an SUV type thing, but you'll hop in there with you and 4 other people. There'll be no one driving the thing. You won't even want to have a car. I think maybe the need for even a garage and a house may completely go away. There'll always be people who want to collect old, Corvettes and Porsches and that sort of thing. But I think the mainstream, 15 years from now, I think the idea of actually owning your own personal automobile will be a foreign idea. So you think of sort of long-term trends, even electric vehicles will need tires, but people who maintain internal combustion engines, that business is going to go away. Has to.
Yeah, it makes sense. Now it's, it's a computer with wheels. It's not really.
Look, they don't even know how long electric motors last, but you'll get sick of the car before the electric motor runs out, because there's just very few moving parts. There's no transmission. So there's no fuel system, right? So, to the extent there's fewer moving parts, you'll still have, the electric vehicles still have tires and brakes and those sort of things. And, they'll have, the accoutrements inside of, air conditioning and stereo systems, et cetera, et cetera. But what makes the car run, the engine itself, will be far simpler. And so it always seems surprising to me that now that, electric cars trade at a premium or something like a Tesla, when in reality, they should trade it at a material discount based on manufacturing costs, because they're much cheaper to make. The only reason you don't all drive electric cars now is the batteries aren't so great, right? Because it'd be very difficult if you want to drive from San Francisco to San Diego without stopping. You could do that in a number of internal combustion vehicles. There's very few electric vehicles that could do that.
Right. And the infrastructure for living in the city and being able to plug it in and all that stuff is still not quite there yet. So let's move to, what we're seeing, and again, this is always a little bit of a sticky wicket in the sense that, there's going to be some generalization. So we'll caveat it by saying that. But what are you guys seeing in the technology sector in general? And then we can drill down if you want from a multiple perspective. So let's just take a typical software recurring revenue business, coming out of 2020 into 2021. What are you guys seeing? And I'll maybe, Tom, if that's something you can answer. If not, Tom Lay, I'll pass it back over to Andrew or one of the bankers.
Yeah, one of the other guys maybe a lot better doing this than I do, because we're not doing change of control transactions. So obviously, we sort of think about the multiple, but not that much, because you think about what I'm doing. I'm trying to solve for a number of net to our limited partners. So we have a bit of a hybrid security. So, in the old days, which were only say 7 years ago, the vast majority of the deals we did were structured as subordinated notes with warrants. So we're getting a current return somewhere around 10%. And then collectively, at the back end of the investment through warrants, we were getting an all-in return in the high teens, sort of 17, 18%. Fast forward to today, we'll still do a subordinated debt deal as I described, but I would say nearly 85% of what we do today is structured as a preferred stock. And as all of you know, preferred stock has many more debt attributes than equity attributes. Having said that, we're categorizing that current return as a dividend. So again, the dividend is being close to 10%. through the common, we're getting an all-in return, got to come a little more than halfway there on the dividend. We're delivering a return in sort of the high teens net to our limited partners. So that's the number that we're actually solving for. So I'm not really the greatest guy to talk about sort of the whole chain, selling the whole lump. The thing I will say about our investments is, and I mentioned earlier, we're kind of the gateway drug. When we exited a company, 4, 5, 6 years later, as I said, very sort of flippantly, well-run companies have many options, all of them good. Poorly run companies have very few options, most of them bad, right? So if you have a well-run company, we have been taken out by internally generated cash flow. We've been taken out by commercial banks. We've been taken out by other finance companies, up to and including the sale of the entire company. But given that we're minority shareholders, we'll have a board seat or board observation rights, but we can't control the board. I can't fire the management team if I want to, and sometimes I do, but I can't do that because I'm a minority investor. So I just have to, we're kind of like a Labrador retriever, friendly, happy, tail wagging, wet nose, want to go on a hike with you. But we view ourselves as consultants with capital, trying to make these companies bigger, better companies. But some of these other fellows could tell you sort of the multiples on a complete change of control far better than I.
Yeah, that's helpful. Anybody else want to weigh in?
I think there's certainly the multiples have gone up. I mean, you can just look at public markets and see, a lot of things are derivative off of those. But, as a byproduct of that, what we see is the lending, valuations and equity returns are what they are. But what helps facilitate those multiples is in part, more lending options to technology companies. 10 years ago, there was almost none, available to a SaaS company. People didn't fully understand it, didn't know how to lend against it. And now you're seeing a lot of more traditional lenders spin up ARR, MRR lending facilities, which enable equity buyers to say, okay, I can get cheap capital and, I can derive the same returns and pay more. And obviously rates on top of that are lower. So, multiples are definitely higher, but underlying all of that is kind of a financing alternative that's been spun up. And we see it in traditional groups that were doing purely manufacturing lending are now spinning up ARR lending facilities. And so it's not a surprise that that's partially what's helping, drive these valuations higher.
Yeah, agreed. And look, at the end of the day, there's someone want to maybe comment a little bit on, the bifurcation perhaps that they've seen, with, I think Tom Lay, you already alluded to it, which is, the good company, bad company thing. And so, you obviously can't generalize here, but I think what I've seen in my own little world is that for the good companies, premiums have gone up, and that's partially a function, Andrew, as you suggested, of the availability of leverage, which went up and down a little bit last year and all around, and now I think it's come back and settled back to almost pre-pandemic levels, or in some cases even higher. So let's see. How about though? We just went through an unprecedented time where, as we talked about, some companies have done really well. How do you guys look at it and de-risk whether or not, a really good year last year was sustainable? And how do you value that as part of your diligence and part of the deal?
You know, a company got a pop because of COVID-19?
That's correct. And how do you
like, for example, there's a company in a healthcare company that was doing COVID-19 testing, and last year nearly 60% of their profits were from COVID-19 tests. In my world, I discount that to zero, literally to zero, because the COVID-19 will come to a hard stop pretty fast.
Well, agreed. Right. So that's an easy one. That's an easy one, right? That's an easier one. Yeah.
We've broken it down to COVID defensive and COVID cyclical companies. So you have things like the cyclicals are the retail store, the restaurant, the hotel, office REITs, et cetera, et cetera. The defensives are, analytics, e-commerce, and digital entertainment, consumer durables. Those are the real breakdowns. We're definitely going to start seeing, I expect, like, travel is going to be huge. People are dying to get out. I flew to Europe twice in Q4, and I can tell you that I slept on. I could fly coach and get a whole row for myself. and there were still rows available on the flight. So.
Right, right. Well, it looks like, I think we've got a couple minutes left here, and I wanted to see if there's, I don't see any questions in the Q&A, but if folks are have questions for the panel, we can go forward with them now. And if not, maybe I'll give a couple of seconds here to put in a question. If not, I'll ask everybody for their final thoughts and we can wrap this up. All right, well, you guys, I think we answered all the good questions, guys. So let me just go right down the horn here on my screen. Tom Kastner, final thoughts.
Okay, sure. Yeah, one thing we're looking forward to is the, for international buyers, international deals to come back. We're starting to work on a couple international deals, whether that's buy side or sell side, where our client is not based in the US. So we see a little bit coming back. International companies are 10, 20% of the deal market, and they've been frozen out for about a year. So we're looking forward to them coming back.
Great. Andrew?
Yeah, I mean, I think we're looking at a lot of things that, the trends that we've talked about, data, technology, all those things exist. I think for the companies that we deal with, one of the challenges is that, how do you have the people that can make and maximize the value in these things and make heads or tails of it. And so, we've seen a lot of interest in continuing education businesses that can help deal with all the different technologies out there, learning curves for executives that are now dealing with things that they've not seen before. This is until we get true AI, I guess, the people still ultimately are what you need. And these are small companies, and most of what we deal with sub $100 million. So, things we're looking for are kind of the talent base around the technology to make use of it and maximize it and unlock the value around it. Strategies. So we're starting to see a lot more experts, and we're using more experts around our companies to help fill in some of those talent gaps that may exist in companies until they can afford them. Because sometimes it's hard to have those deep expertise inside of companies. So having, those part of our value proposition as a firm, and trying to really unlock the value of all these things that, we talk about, but truly day to day are quite hard.
All right, Marcus.
My final thoughts are, I always ask companies, what is the biggest driver of change in your company in 2020? And it was always your CEO, your CTO, or COVID-19. The clear winner is COVID-19. And a lot of changes are actually quite good. And it's going to drive a lot of growth for a lot of these companies.
Great. And last but not least, Tom Lay.
Yeah, I think that, coming out of this, we can definitely see the light at the end of the tunnel now, right? With the multiple vaccines out there, certainly by the end of the summer, virtually every American who wants to get it will have one. So that will change a lot of things, because obviously the hospitality lodging has been just clobbered. But you do look at some long-term effects of this thing. People probably have decided that, maybe the retail space in those shopping malls that we grew up with, those there may be no need for those. People may really start questioning whether they need to pay $100 a foot for a fancy office space in downtown San Francisco if they can outsource that. So I think all those changes are going to be felt, but I think in the end, I think companies will be much more efficient and likely more profitable coming out of this.
Great. Well, I'd like to thank the panelists, Opus Connect, for this great day of deal making, and those of you that are continuing on. Hopefully, it's a very productive conference.
Thank you, Ryan, and thank you to our panelists. We appreciate your contributions to that discussion. We hope the audience found it fruitful. We have a lot going on, as I mentioned, and as you can see here, these are just a few of our upcoming events. So stay tuned. We will keep you posted. I'd like to thank our sponsors, of course, for your continued support. If you are participating in today's Deal Connect one-on-one meetings, you're going to want to log out of this link now and log into the separate link that was circulated yesterday by one of my colleagues. If you have any questions or trouble getting in, feel free to reach out to us. But in the meantime, everyone stay safe. We hope to see you all soon, and be well. Thank you again.
Thanks, everybody.
Bye, guys.